Welcome, everyone. So today we're going to dive into a question that is at the heart of finance. It's a question that every single investor, whether you're managing a multi-billion-dollar fund or just your own savings, has to ask. When is the absolute best time to sell? And we're going to answer this using a tool you've all seen before in algebra, the quadratic function. This is where the math you learned gets real, where it stops being theory and starts becoming a powerful tool for making much, much smarter financial decisions.
Okay, here's our game plan. First, we'll lay out the business problem we're trying to solve. Then we'll get into the math and decode the model itself. After that, we'll calculate that precise tipping point, the moment of peak value. And then, and this is the really critical part, we'll talk about how you take that number and turn it into an actual, real-world business strategy. And finally, we'll look at some of the common mistakes people make with these models so you know what to watch out for. Ready? Let's jump in.
So let's really frame this challenge. At its core, this is the million-dollar question in finance. It's what separates a good return from a great one, and it's something that can genuinely make or break a portfolio's performance over a year. So here it is. When is the perfect time to cash out for the biggest possible profit? It sounds so simple, right? But the answer is anything but. If you sell too early, you're leaving money on the table. You're kicking yourself watching it climb higher after you're out. But if you wait too long, you could watch all of that hard-earned growth just disappear. Now, in business, we don't like to guess. We certainly don't rely on gut feelings alone. We use mathematical models to give us a strategic edge. And that is precisely what you're here to learn.
So to answer our big question, we're going to need a tool. And in the business world, that tool is a mathematical model. I want you to think of it as a kind of flight simulator for our investment. It's an equation that lets us project how our investment might behave over time, letting us test out different scenarios without risking real money. So why a quadratic function? Well, because so many things in the business cycle follow this natural arc. Think about it. A new product launch, a hot new stock. They often see this period of really fast growth. They hit a peak as the market gets saturated, and then they start a slow decline. That up and down shape of a parabola, it's a fantastic match for that real-world pattern.
So here it is. This is our model. Now, I know at first glance it might just look like another equation from a textbook, but I want you to see it differently. This is a story. It's a story written in the language of mathematics, and it tells the tale of our investment's life, its birth, its climb to the top, and its eventual fall. Our job as sharp business minds is to learn how to read this story and use it to our advantage. Now, before we can interpret that story, we have to understand the language. That means defining our variables with absolute precision. First, we have t. That's our time, and we're measuring it in months. That's our independent variable. Then there's v of t, which represents the value of our portfolio at any given time t. Now, here is an incredibly important detail, one that can completely derail your entire analysis if you miss it. See that? The value is in hundreds of dollars. This is not a small thing. If you forget this and you calculate a peak value of, say, 500, you might report a peak of $500, but the actual value is 500 times 100, or $50,000. That's a mistake that doesn't just get your numbers wrong, it gets you fired. Always, always pay attention to the units. All right, let's unpack the story hidden inside this equation. Every single piece of this function tells us something. Let's start with the 50. That's our constant, our starting line. This represents our initial investment of 50 times $100, or $5,000. Simple enough? Next, look at the plus 73t. This is our growth engine. This is the term that shows that powerful early momentum. For every month t that goes by, this term is initially adding a whopping $7,300 to our portfolio's value. This is the good news part of the story. But then we have the most critical piece for our analysis, the minus 3t squared. I want you to think of this term as the force of gravity. It's what eventually slows the growth and pulls the value back down. This represents all those real-world pressures. Maybe the market is getting saturated, competition is heating up, or the economy is slowing down. It's the mathematical signature of diminishing returns. And this right here, this is why we're using a quadratic function. In the standard ax squared plus bx plus c form, that very first term, the sign of a, tells you the entire shape of the story. Since our a value, the number in front of t squared, is -3, it's negative, we know our parabola opens downward. It looks like an N. It tells us our story has a beginning, a middle, and an end. It goes up, hits a climax, and comes back down. If a were positive, the story would be completely different. It would be a U shape, a story of hitting a bottom and then recovering.
which is great if you're trying to model something like minimizing costs. But for finding a maximum profit, this downward-facing parabola is exactly what we're looking for, because it gives us a mathematical guarantee that there is a peak, there is a maximum value we can find.
Okay, so we've established that our investment story has a climax, a single fleeting moment where its value is at its absolute highest. So the next logical step is to figure out exactly when that moment happens. Mathematically, what we're looking for is the vertex of the parabola. This is our tipping point. This is the moment of maximum opportunity.
Now, to find this tipping point, we use a beautifully simple and powerful formula, the vertex formula. Now listen, it's not enough to just plug and chug the numbers here. As business leaders, you need to understand why this works. The vertex is the one point on the curve where the slope is perfectly flat. It's not going up anymore, and it hasn't started going down yet. This formula, t equals negative b divided by 2a, is actually a shortcut derived from calculus that finds that exact point for you. It's pretty neat. So let's walk it through. First, we identify our a and b from the equation. A is negative 3, and b is 73. Easy. Next, we carefully substitute them into the formula. So t equals negative 73, all divided by 2 times negative 3. That simplifies to negative 73 divided by negative 6.
And there you have it. That's the answer to our million-dollar question. The model is telling us that the optimal moment, the perfect time to sell this investment, is approximately 12.17 months from the start. This single number, this is why we did all the work. This is our strategic insight. It's our edge. But here's the thing. A number on a spreadsheet is basically worthless until you know what to do with it. The true test of a business leader isn't just crunching the numbers to find an answer. It's translating that mathematical answer into a clear, decisive, and actionable strategy. So, how do we make that leap? Okay, I want you to picture yourself in the conference room. You're presenting your findings to your team. You're not just going to say, the answer is 12.17 months. That's not leadership. You're going to say something like this. All right, team, listen up. Our model projects that this asset is going to peak in value in just over 12 months. That is our signal. That's our window. I want us to begin preparing the exit strategy immediately. That means legal. Start drafting the sale agreements. Operations, I need you to make sure all channels are ready for the transaction. We will do a final check on real-world market conditions at month 11 to confirm. But this number, 12.17, gives us our target. It tells us when to get ready to act. See the difference? That's turning data into a decision. And that brings us to what might be the most important lesson of all today. A mathematical model is an incredibly powerful tool, but it is not a crystal ball. I love the analogy of a map. A map is fantastic. It shows you the terrain, it helps you plan your route, but it cannot predict a sudden thunderstorm. And in business, believe me, the weather can change in a heartbeat. So let's talk about the traps that analysts, even experienced ones, can fall into. The first big one is believing the map is the territory. They forget that the model is a simplification of a much more complex reality. The second is getting so focused on the math that they stop looking out the window. A sudden change in interest rates, a new competitor, any of these things can make your beautiful model totally irrelevant overnight. The third, as we've already hammered home, is misreading the map. Forgetting that the value is in hundreds of dollars is like reading your map in miles when the scale is in kilometers. It's a small mistake that leads to a huge disaster. And finally, the biggest mistake of all, following the number blindly off a cliff. That 12.17 isn't a command from on high. It's a piece of strategic intelligence that you must use alongside your experience, your wisdom, and your professional judgment to make the best possible call. So what's the bottom line here? It's this. We don't use these sophisticated models in business to find some single, perfect, guaranteed to be right answer. That doesn't exist. We use math to cut through the incredible noise of the market and find the signal in the static. These models give us a framework for our thinking. They simplify a chaotic reality just enough so we can see clearly and make smarter, more strategic decisions. And that leads me to my final question for all of you. The model we built today was simple, it was elegant, and it was quite powerful, but it was based on only one variable, time. So for your next challenge, I want you to start thinking, how could you make this model even better? What other real-world, quantifiable variables could you build into this equation? What about things like the prime interest rate, or maybe sales data you get from a competitor's quarterly report, or even something like a consumer sentiment index? How would you decide how much weight to give each of those variables? And how would you test your new, more complex model to see if it's actually more accurate? That right there is the next step in your journey as a business analyst. And it's a journey that will take you from this classroom straight into the boardroom.